Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. So we just got earnings from CrowdStrike. I know a lot of people have really been anticipating this. We've seen a lot of other cloud SaaS type companies have reported. Revenue growth is slowing, a lot of things that are disappointing investors. CrowdStrike, the stock was down the morning of the earnings release, but by the end of the day, pretty much finished about break even. So there was a lot to like here. You dig into the results, it absolutely crushed it. But here's the thing, it might not even be the best cybersecurity stock to buy right now. I'm Jason Hall. This is The Smattering. So happy to have my co-host, my good friend Jeff Santoro, back on our stocks videos with me. Hey, Jeff, how's it going, buddy?
Hey, good to be back, man. I'm happy to talk about one of my favorite companies, actually two of my favorite companies, CrowdStrike and the one we're going to talk about afterwards.
Yeah, we're going to bury the lead a little bit. We're going to kind of keep it a little bit secret which one. I want to focus on CrowdStrike to start with. Again, just reported earnings, I think after the bell yesterday or before the market opened this morning. I can't remember which.
After yesterday, yeah.
After yesterday. So today was the first day of trading after the report came out. Jeff, hit the high notes for us. Tell us what we saw.
So essentially everything went up and they beat and raised on everything. So they beat all their guidance, their internal guidance for this quarter. They beat on all of it. Total revenue was up 42%. Subscription revenue up 42%. Gross margin improved a little bit. And they actually ticked into positive territory for net income for the first time.
On a
So
GAAP earnings basis
gap
instead of
in earnings
adjusted.
basis.
Right, right.
Exactly. And they're still generating a ton of cash. Like the short story is even as revenue growth has slowed, so that 42% we saw this quarter has continued a trend of slowing year over year growth for the last several quarters, which you're seeing in just about every tech company right now. But as that's happening, they're still becoming more profitable. At first, they were narrowing their gap losses, and now they finally ticked into profitability. And their cash generation is accelerating each quarter. A little bit more free cash flow, a little bit more operating cash flow. So that's operating leverage in essence. They're slowing revenue, but they're becoming more efficient in how they run the business. All of their guidance for the full year got raised. Every single one of them raised for the full year. They are guiding for next quarter for continuing slowing growth. But again, if the operating leverage can kind of continue, I don't think that's a big problem. So that's kind of the highlights here. I was surprised to see the aftermarket reaction yesterday and the pre-market reaction today. But it seems like as the trading day has gone on, more people have looked at it and kind of realized this wasn't as bad as the market was making it look at first.
They don't give us as much information about modules as they did, say, a few quarters ago, but they still kind of break it down. And we know that I think at that 5+ modules, at that level, it's like almost 2/3 of customers are subscribing to at least 5 or more modules. And that's great because that land and expand model is working. A company signs on for a little bit, they add a little bit more, they add a little bit more, and the relationship gets stickier. So that's all good. I love that. And again, this is one that you and I both own. You and I both intend to continue owning this. There's going to be multiple winners, as we've already seen in cybersecurity. Microsoft is pretty involved in cybersecurity. They're very competitive. But there's another player in this space that's doing really, really well too. And I, for one, I think it's probably the better buy right now, and that's Fortinet. You want to share your thoughts on Fortinet?
Yeah. So if you look at the results of Fortinet and consider that they're a larger company that's been around for longer, the the growth that you see with Fortinet is almost as good as CrowdStrike. So whereas CrowdStrike grew 42% year over year in this quarter, Fortinet grew in the 30% for the last couple quarters. It was about in the 20s historically before that. But at that size, it's about a $20 billion more market cap business. For them to continually grow 20, 25+% each year, that's amazing. And they've been profitable and cash generative for a really long time. So just as CrowdStrike has been improving its profitability and just ticked over into a net income in the positive side, Fortinet's been profitable for years. So, they're comparable in their performance. And I know you're going to talk about the valuation for one versus the other is pretty stark.
Yeah. So again, the key, I think, is in terms of thinking about the businesses, you nailed it, right? Two very high level executing businesses have sticky services. They compete with some of the things that they both do in cybersecurity, endpoint protection, other things that they compete with one another on. But it's a massive market, and there's plenty of room for multiple winners. And I think that's going to continue to be the case. But just kind of comparing the two head to head, again, I don't think you have to pick one or the other, again, to find one that's going to be the winner. But if you're looking to deploy new money today, I think Fortinet really comes out way ahead. So again, you talked about the size of the companies in terms of revenue. Over the past 4 quarters, about $4.7 billion in revenue from Fortinet, about 2 and a third, $2.5 billion of revenue from CrowdStrike. So again, double the size of the company in terms of revenue. They have similar profiles, about 75% gross margins, right? So starting at, the gross margin they get from the product itself, really, really high margin products. But then because of the difference in the scale of the two companies, Fortinet starts to separate itself and be a little bit more profitable. It generates, like you said, it's been gap profitable for a long time. Generates 23% operating margins. CrowdStrike over the past 4 quarters is still negative because they're just breaking that point where they're generating positive operating margins. And then the valuation, again, twice the revenue, more profitable business. Now, using some metrics to make it easier to break that down, and I really like to use cash generation metrics for these companies right now. Again, it adjusts for the fact that those gap losses with CrowdStrike, it's a way to kind of get past that because again, it's kicking out cash flow, right? So we know that on an operating cash flow basis, you're still paying about 39 times operating cash for CrowdStrike compared to about 27 times for Fortinet. On a free cash basis, 54 times for CrowdStrike and 30 times for Fortinet. So what that means is that Fortinet, because it's 30 times versus 27 times, that's not a lot higher free cash flow versus operating cash flow multiple. That means that it's extremely cash generative on a free cash basis. It's not having to take a lot of that cash from operations and then spend it on capital projects to continue to fund future growth. It's already gotten to a scale that CrowdStrike investors are hoping to get to. Pretty simple to me. The math says the one you want to buy today is the one that you can get the better valuation on. And to me, there's no doubt that that's Fortinet. If the market gives us an opportunity at some point to pay a more reasonable valuation for CrowdStrike, I'll back the truck up. But today, Fortinet's the one that I want to buy.